Good morning, students. In last class, we were discussing about equity shares, and equity shares are also known as common shares or ordinary shares. And equity shareholders are considered as owners of the company, and how it is considered as ownership. In last class, we have discussed. Fine. So in today's class, we are going to discuss about. Please make a note of it. Note down all these points. Uh, all these points they may ask as salient features of equity shares, and in your some exam, this concept may be asked for 5 marks. Very easy to remember. Equity shares are called ordinary or common shares, and equity shareholders are considered as owners of the company because they are entitled to get part of profit. And equity shareholders have control over the working of the company. That means they have voting rights in decision making. So, how do they vote and in what occasion they vote? Equity shareholders they never participate in day-to-day activities of the business or day-to-day transaction, each and every transaction of the company. They never interfere. But see, in this point, we are saying that equity shareholders control the operations of the company. How do they control? Yearly once in a year, they meet, and that meeting is called as annual general meeting (AGM). Please do remember, annual general meeting is the meeting of owners or meeting of all the shareholders of the company. So whatever the decision they intend to take, they take by voting. So that's why we have written here, equity shareholders enjoy voting rights. So the major decision, say for example, if the company called ABC is going to acquire company called PQR. This decision, whether we are going to acquire PQR, whether we are going to buy this company or not, this decision is taken in annual general meeting by equity shareholders. So they have voting rights, and majority of the major decisions are taken in AGM, and those decisions are executed by board of directors as well as CEOs, chief executive officer, and managing director of the company. So major decisions are taken by its owners. Owners are equity shareholders. When they take all these decisions, in annual general meeting. Annual general meeting is conducted each and every year. So annual general meeting is the meeting of owners of the company or equity shareholders. So please do remember, this is the very important feature. Equity shareholders have voting rights. Voting rights in the sense, while taking decision, while passing resolution, they vote. And equity shareholders are paid dividend, and this dividend for 2 marks, very important. What do you mean by dividend? So dividend is the part of profit equally distributable among its shareholders or equity shareholders. So since we consider as equity shareholders are owners of this company, since they are owner, they have the right to the income of the company. That means they have right to get the part of profit earned by the company. So dividend is nothing but the part of profit distributable among its shareholders, its equity shareholders. So first of all, when company earns profit 100 rupees, say for example, if company has borrowed a loan from bank and interest on loan is paid first, say for example 20 rupees is paid and remaining 80 rupees profit, they distribute dividend to the preference shareholders. Then preference shareholders may be around 30 rupees. Remaining 50 rupees, remaining 50 is the profit available to equity shareholders. If there are 50 shareholders or 50 shares, profit is 50. So each shareholder will get 1 rupee as dividend. That means the part of profit equally distributed among its shareholders. That is called dividend. In this case, 1 rupee is the dividend. Hope you understand. Hope you understood this concept. So equity shareholders are paid dividend. That means they have right to income or right to profit of the company. And equity shareholders liability is limited. What does this mean? Who are equity shareholders? Equity shareholders are owners of the company. And this owner's liability is limited. What does this mean? Say for example, this owner or a company has distributed 100 shares. Fine. Each share is worth 10 rupees. So there are 100 equity shareholders or 100 members, 100 owners of this company who have invested rupees 10 each. So the company's capital by issuing shares, equity share is 1000 rupees. So since there are 100 equity shares and each member has invested 10, what happens if company liquidates? That means if there is a huge loss and company shut its door, what happens to the investment of these owners? And company has borrowed loan from many banks and many other financial institutions. Now, these banks and financial institutions, since these people are the owners, these 100 members or 100 number, these are the owners, these banker or financial institution cannot come and ask these people to repay their loan amount, to repay this company's debt. Even though these people are the owners of the company, their ownership is only up to 10 rupees. So their part of the ownership is to the extent of 10 only. That means we are discussing about liability of the owners or liability of the equity shareholders, and equity shareholders liability is only to the extent of their investment only. Even though they are the owners, any other financial institution or any other creditors or any other lenders cannot come to their home and ask for repayment of loan. So what they lose their investment part only, even though they are the owners of the company. So their liability is limited only. This is the biggest advantage of joint stock company or public company. So we will discuss what does this joint stock company, public company and all in next chapter. So this is very important. The things to remember is about features of equity shareholder, equity shares. They have right to income. That means they are entitled to get profit. And their liability is limited. They have their voting rights because they control the entire operations of the company by voting to pass resolution. And these are the very important features. So you have to remember some exam. This is the probable 5 marks question. Salient features of equity shares. Now the advantages. Again, these features can be termed as advantages also because see there are many common points in these. One thing, no charge on assets of the company. What does this mean? If the company is going to issue share, if the company intends to borrow 1000 rupees, company needs 1000 rupees for its further operation or expansion of its business. The sources for capital for this company ABC, this ABC company needs 1000 rupees for its business expansion. Now, there are two options this company is having to raise this capital. One is to borrow loan from the bank, and another one is shares. If company intends to borrow loan, that banker or financial institution may ask for security, that is mortgage. Banker may ask, see, you need 1,000 rupees, I will give you a loan of 1,000 rupees. But as a security, you have to pledge or you have to mortgage your factory premises or your business premises, business establishment, buildings, machineries, and the papers of land the company is having, etc., etc. So that means if company borrows loan, there will be a charge on assets of this company. That means a mortgage. So this company has to give certain security to borrow loan if the company intends to borrow loan from financial institution or bank. If company is going to issue shares, no such securities are given against this 1,000 rupees. That's what this point, and that is the advantage of equity shareholder equity shares. That there will be no charge on asset. That means in case of issuing equity shares, no security is being provided or given. And it is considered as permanent and long-term source of finance. Again, if you borrow loan, you have to pay the interest and you have to pay part of principal amount also. See, loan is usually borrowed for 5 years, 10 years, 15 years, 20 years. Within that stipulated period, you have to pay back your entire borrowed money to the bank or financial institution. If in case you issue shares, if the shareholder needs their money back, they sell their share in secondary market. They never come to this company and ask their invested money. That's why equity shares are considered as permanent. And as long as company survives or company operates, this share amount never going to be liquidated unless company intends to. So permanent equity share is considered as permanent and long-term source of finance. And dividend is to be payable only when profits are earned. What does this mean? If in case company earns 100 rupees and company's interest on loan is around 80 rupees and interest is paid first and remaining 20 rupees is the dividend payable to preference shares. So dividend payable to equity share is only after paying dividend on preference shares. So when company remaining 20 rupees profit is payable, dividend payable to the preference shareholders, this 20 rupees, then the profit available or fund available to equity shareholder is 0. In this case, no need to worry, no dividends are payable by the company. So this is one more advantage. If there is a profit, then only you distribute dividend to the equity shareholders. And equity shareholders' dividends are not accumulated. That means if this year there is a loss, next year if profit comes, out of that profit, previous year's dividends are payable. No, not in equity share case. So equity shares, if in case of equity shares, dividends are payable only when there is a profit available to equity shareholders. If there is no profit, no dividend to the equity shares. This is one more advantage. Even if if you are not going to earn profit this year, next year also, but you have to pay the interest. You have to pay the interest on borrowed money. Otherwise, you will be considered as bankrupted. Fine. Then this equity share market is very wide, very large because equity shares usually their nominal value is very nominal. Their nominal value is very small. That means their face value and marketable value is very small. I can take this illustration also. There is this company is going to issue 100 shares. they are issuing it only rupees 10. So 10 rupee, many people will invest in this company. So that is the biggest advantage. Small nominal value, since there is a small nominal value, it has got huge and wide market. Again, we have explained here also, liability of the owners are very limited. This is the biggest advantage to the owners of the company because their personal property is never going to sue by the creditor. That is why this equity shareholders liability is considered as limited only. So in next class we are going to discuss about preference shares. Thank you.